George of the jungle, strong as he can be.
Does it matter whether or not you should put your spouse on the loan with you if you don't need to? This is a very common question that I get, so that's what we're going to talk about in thecreditjungle.com today. Thanks for joining me. This is George Anderson. As I've talked about in a previous video, Utah is what we call a joint tenancy state, tenants in common state. We are not a community property state. We are one of the few states in the western U.S. that is not a community property state. Go look into a little bit of Utah's history and you might understand why that's the case. But that's another discussion all in itself. But anyway, so it's possible for one spouse who has good enough income and good enough credit, and maybe if both spouses are working, that one can just qualify all on their own to be able to purchase the home. So do you want to put the non-borrowing spouse, do you want to put them on the loan? Well, you don't have to. You don't need to if there's no requirement to do that to make the debt-to-income ratios work. Now, if you have a spouse that's not on the loan, and let's just say that that spouse has their own separate debts in their name, but maybe is unemployed at the moment, or for whatever reason is not working, choosing not to work, or I can't count the income. Those debts, if I put the spouse on the loan, even though I can't count any income, I automatically have to count those debts. So sometimes to make the loan work, you have to do it in the name of one spouse only. Now, does that mean that they don't have an interest in the house? That they don't have any collateral? Or what happens if the other spouse who's on the loan passes away? The nice thing about how we do things in the state of Utah is that you can put both borrowers on the title to the loan. So again, when you're creating a mortgage, there's two documents that basically govern a mortgage loan. One of them is the deed of trust. The deed of trust says who are the owners, who is on record, on title on this property, and is there an indebtedness on the property, a trust deed that's secured by a note, and who would that be? And it would list what the name of the bank was and the amount of the debt. That is public record. Okay, in the state of Utah, that's public record on who owns the house and whether or not there's a debt and who that debt was secured by and what the original amount of the loan was. That trust deed doesn't necessarily have to have the same exact information on it as the note. So the trust deed note says, well, what are the terms for repaying that loan? What's the interest rate? Is it a 30-year loan? Is it a 15-year loan? Is it a conventional, an FHA, or a VA loan? So the note can have just one person on it. So in other words, the husband and the wife can have equal ownership and they can share the asset, but the liability can be in just the name of the borrowing spouse. So these are just things that I go through with people when I'm taking an application and just say, do we want to put your wife on the loan, or do we want to put your husband on the loan? Do we need to? And then people say, well, what's the advantage and what's the disadvantage? And everybody's circumstances are going to be the same, and the answer, or whatever option you choose, is going to be a case-by-case scenario depending on your understanding of the law, how it affects the title to the home, how it affects the liability on the home, and how it affects your ability to qualify. So again, one more reason to push button, get mortgage professional. This is George Anderson, and thank you for coming into thecreditjungle.com. Have a great day, and I hope to talk to you soon.